And it's 10 a.m. here in Lagos. Thank you for joining us. This is Business Morning. I'm Ladi Williams.
And I'm Ini John Mekwa. Good morning and welcome. Well, hundreds of thousands of people a year are dying from long working hours, and that's according to the latest report from the World Health Organization. The global study, which is the first of its kind and conducted with the International Labour Organization, also showed that almost 3/4 of those that died as a result of working long hours were middle-aged or older men. While the study did not cover the period of the pandemic, WHO officials say that the recent jump in remote working and the economic slowdown may have increased the risk associated with long working hours. The research found that working 55 hours or more a week was associated with 35% higher risk of stroke and a 17% higher risk of dying from heart disease. And this is compared to working a week for 35 to 40 hours.
Wow.
Ladi, this needs to be thought about, you know,
yeah.
and put into the reality of everyday life.
Exactly.
Especially when you look at the age group concerned, middle-aged and older men.
So you need to be careful there. That's why it's good to always try and exercise, you know, to help your mental health and also help your body.
And you know, the pandemic also brought, the pandemic also brought another perspective to it.
Yeah.
Because a lot of people work from home, so you hardly have a closing period and a working period. So you're home, you're just on the computer.
Yeah.
You know, I know of a friend who lost a brother recently because of the exposure to the device that was excessive. So, I mean, I think this is more than just the news. Should be taken back home.
Should be taken seriously. All right, oil prices climbed today, extending gains from the previous day, and as optimism over the reopenings of the U.S. and European economies outweighed fears of slower fuel demand in Asia due to surging COVID-19 cases and a new wave of restrictions. Brent crude oil futures was up 20 cents at $69.66 a barrel, while West Texas Intermediate crude futures was up 19 cents at $66.46 a barrel. Both contracts rose more than 1% yesterday. In India, the second hardest hit by the pandemic, domestic sales of gasoline and diesel by state refiners plunged by a fifth in the first half of May from a month earlier as pandemic lockdowns hit industrial activities and consumption. Well,
here in Nigeria, headline inflation has slowed down to its 20 consecutive months, dropping to 18.12% in April, year-on-year, from 18.17% in March. According to the latest data by National Bureau of Statistics, food, urban, and rural inflation also dropped, leaving core index on the high at 12.74%, driven by increases in pharmaceutical products and other items. The report also shows that Kogi, Bauchi, and Sokoto states recorded the highest inflation, while Abia, Kwara, and Katsina had the lowest inflation in the month on the review. The latest data by the NBS beats the expectation of economists. I can't remember any economist who said this will go down, who had projected that a continuous increase in the inflation is what. Yeah, I can't think of anyone. This is quite a shock. But so certainly top on the list of burning economic issues in Nigeria at this time is the inflation figures, which was released yesterday. It's a major discussion on commodities market updates with Nosike Nwajide, an analyst from Financial Derivatives. He is the one who will discuss with us just after this break. Welcome back. Well, we're discussing at the commodities market update segment now, but obviously the inflation that was released yesterday is up on the list, and we have introduced, Nosike Nwajide is here. Nosike, you have a lot to talk about. Were you surprised when you saw the figures yesterday?
Or shocked?
I don't think there was anyone who wasn't surprised. I think besides the MBS. I'm sure some people at the MBS were surprised themselves because it goes against, I mean, the anecdotal evidence around us. Everything we see, we feel, the prices are going up. Yeah. But the empirical evidence... Because
even FDC said it was going to be 18.77%. Yeah, that was your projection.
Headline index, we projected an increase in the food index, but right now the food index has declined by about 5 percentage points. And we're scratching our heads as to why. But if you think about it, around this time last year, at the beginning of April in 2020, that was when the lockdown started. That's when, you know, we couldn't go about our business activities the way we wanted to. There were supply chain constraints, so prices rose. There was scarcity, and there was that increase in prices. So the year-on-year index, I mean, you measure inflation basically. That price, that's number you see, 18.12, basically measures how quickly prices have risen against last year. So if you say that inflation has declined, it's not like prices are falling. No. It's that prices have risen, but at a slower pace. So if you're measuring against a base year number that, you had in April 2020 an increase in prices, and this year you have an increase in price, it just means the increase in price this year wasn't as fast.
So are you saying that the price of bread, the price of vegetables, the price of yam today is cheaper than it was last year at this time?
No,
I mean, let's talk about the realities.
I'm saying the prices have risen, but not as quickly as they did last month or the year before. Okay. That's basically what I'm saying.
But when can we expect to feel, the impact of this?
Because if we say it's rising, but not as a fast rate as last year. But I mean, now we're buying a bottle of water that used to be 50 naira, it costs about 100 naira. Exactly. Pure water is about, I think they said it's about 20 naira now.
Yes.
Bread, a bag of rice. I mean, I was trying to buy fish the other day. Do you understand? So those are the realities.
The anecdotal evidence is that the prices of everything in the market have risen. So if it's the number you have is a general price level, the price level across the country, the basket of goods across the country. But in the urban centers, like Lagos is the largest urban center, there is that rise in price, but it's slower. It's slower than it was last month.
Okay.
I mean, the prices are increasing. That's what we're saying. And the inflation above 12% is growth retarding, according to the CBN. Inflation above 18% is really high. Well, now we have inflation going from 18.17 to 18.12. It's rising, but at a slower pace. At a slower pace.
All right.
Yes.
Okay. Now that planting season is set to start, how should we expect the commodity price movement to look like?
Planting season, okay, the biggest constraint to the planting season is insecurity. In parts of the food-growing parts of the country, there's a high insecurity. Farmers can't go to the farms, and even when you go to the farms, we don't know what it will be like in a couple of months. How much of what you've planted can you actually harvest? So when you plant, a couple of months down the line, you harvest. So that increase in output is supposed to soften prices. Prices are supposed to be tapered. But in the build-up to this is that there's high insecurity. We don't know how much our farmers can actually go and plant. And even if they plant and harvest, the logistics of bringing it down to the urban centers, insecurity is a problem. Supply chain constraints are major constraints at this moment. So it's my expectations are that it would not taper prices very much in the coming months. That the increase in supply, all these other factors will interplay, and prices will not move.
So is it likely to affect the next inflation rates?
Inflation down the coming months. I mean, the harvest season, we're taking in the planting season. By the time we get to July, August, by the time you start harvesting and you find out that what you're harvesting is not as much as you would have harvested like a year before, 2 years before, then bringing it down to the urban centers, maybe major constraints to that. So that would impact inflation figures in the coming months.
So coinflation was up, like the food inflation and the headline inflation, it was up. And that pressure is most significantly from the pharmaceutical products. Does this have anything to do with the pandemic, the vaccine, and?
Well, the pandemic in itself. Let me just say this before I even turn to coinflation. The food inflation, the food index, one of the reasons, or one of the major reasons why it declined, the food index declined, is that there's been border closure since September 2019, so to speak. The border has been closed. Now the borders have been reopened. And we know that food across the borders, smuggling across the border was one of the major reasons why these borders were closed. Now that these borders have been reopened, we have food being brought, not smuggled anymore, brought across the border. So even when you had to have this insecurity and supply chain constraints in the country affecting domestic commodity prices, that's been softened. So that increase in price is softened by food being brought across the border. Now, this what do you call it?
Coinflation.
Is it affected by things being brought across the border? Some of the products are brought across the border, like the vaccines and other commodities, those are not brought across the border. The exchange rate has been, like I say, it's 480.
Yeah, the exchange rate is even another thing that we don't really understand at this time.
The core index is not really affected by smuggling across the border, so we expect that it will continue to trend high.
All right.
So
all right. Looking at this, do you see this as a beginning of a continuous, downward trend for inflation rate at this point?
No. That's the short answer. The longer answer will be, we'll have to wait and see. It's possible that inflation might have reached its peak. It's possible that there's a consumer resistance to a point, aggregate demand. There's only so much you can spend. It gets to a point that prices are high, you cannot buy as much as you used to, so you cut down on demand. And that will also taper prices to an extent. So we'll wait and see if in the coming months, 1 month is not enough to form a trend. You wait 2, 3, 4 months and you see that, okay, look, the food index is on decline, even core now reverses on decline, and say, okay, look, a trend is forming. We can now say, okay, inflation has peaked and is established, a firm downward trend has been established. So we'll have to wait a couple of months to make
it. So in all of this that we're talking about, how much impact does the issue of insecurity have on these figures?
Well, the impact is major, obviously. Insecurity, like I said, stops people from going to the farms, stops people from harvesting their crops, stops people from transporting goods from point A to point B, typically rural to urban centers. And this is a major, if you cannot, at some point, I think some farmers were even having to bribe.
Yes, they had to pay to,
whatever, to allow them plant.
True, yeah.
You pay to allow you harvest. So all that cost is added to your cost. So that has pushed prices further up.
And so if these factors are not dealt with, we shouldn't really expect
prices to taper anytime soon or have a downward trend. So it's our expectations that this is just a blip, this is a one-off, and prices will trend higher in the coming months.
Except these things have been dealt with.
These things are dealt with.
Well, Brent crude ended the session up 75 cents. What do you think drove the price, considering the constraints with, COVID-19 resurgence in India?
I think it's positive sentiment or increased optimism, reopening of the economy in the US and the UK, particularly as we are getting into the summer driving season, and then the embargo on travel, particularly on air travel and the aviation industry. Increased demand from the aviation industry is going to prop prices up in the coming months, and even in the second half of the year, where there's a possibility that Iran, the sanctions on Iran with regards to the nuclear trade deal will be taken off. Iran has an extra 2 million barrels of oil that it is just literally waiting for the sanctions to be taken off so that it can just bring it into the market. That will have a negative effect on the market. But as it is, increased demand, especially as vaccines roll out in parts of Europe, in many developing countries, even in Nigeria, South Africa, developing countries, there's just increased optimism that prices will rise, even if U.S. shale is beginning to increase output. At the moment, the positive sentiment overrides every other sentiment in the market.
But with what's going on in the Middle East now with Israel and the Gaza Strip, will we feel any impact in the oil markets?
If any, it will be positive. It will be, how could it affect maybe Iran? How could it affect other oil producers in the market? How much output will be taken off the market? And it will have, even if it's temporary, it will prop up oil prices even further.
Okay.
So let's look at happenings in the currency markets. Recently, that was late last week or over the weekend, the CBN removed the official exchange rate of 379 naira to a dollar from its website. Does this mean that the import and export rates and the NAFEX are now a unified rate?
Well, it remains to be established. At the moment, that's what market analysts take that to mean. Over the years, it's been firmly established that every day you open the CBN website and you see that figure. Exactly. If you don't see that figure, it's subject to interpretation. The CBN hasn't come out to say anything, but it has in the past alluded to the fact that the NAFEX rate is now the official reference rate for all official transactions. So the market as it is going to go by what the CBN and even the Ministry of Finance has come out to say that, or even FAC allocations will be converted at that rate and shared to the states. So we'll be going by that figure.
How is this supposed to affect the manufacturers? It's been a long talk, access to Forex.
The truth is the manufacturers for the past few months, over the last year, have been using blended rates. They get there's this, it's rigorous getting money at the official rate or the NAFEX rate from the CBN. It's easier to just go to the parallel market. So you take some or the bulk of it from the parallel market, you take the little you can get at the official rate, and you go about your business. So that's one of the reasons why prices are up in the first place. So that the effect is that it's passed on to the consumer. Prices are higher up, and one of the reasons why the fuel subsidy issue becomes a major problem. I mean, if you're importing the official rates, I think the only people who got money, dollars at the official rate were importers, which is the NNPC themselves. So that's at 379. So now everybody's getting at 410, 412. There's an increase in the landing cost.
Is there no way of solving this problem?
Is either they absorb it or they pass it on. For how long can they continue to absorb it? We don't know. It's a question. I said Labour and the government are trying to reach some sort of agreement that would favor both sides of the party. But I don't know how that will happen. I don't know if there will be an increase in wages. At the moment, we are constrained for cash, as it were. But if you take away the subsidy, then the government can channel its funds towards maybe infrastructure and improving the ease of doing business, which will lower the cost of doing business.
I think the conversation around taking away the subsidy that gets to Nigerians is where will the money go to? How we sure?
Yes, how we sure the money
more pressure.
Yes, will be putting where it's promised to.
That's one side of the argument. The other side of the argument is the NNPC is saying, look, we cannot continue to foot this bill, saying that, look, we may not be able to, remittance to the FAC accounts may be down to zero. That's how bad it is.
No, states should make revenue. We have a lot of natural resources in the states.
Ways to make some revenue. Anyway, just before we let you go, take us through the domestic commodity price movement. It's
all in the red, really. I mean, there's nothing else. It's all in the red. Every single commodity is up. Even house rents are up. Even in the highbrow areas of Lagos, house rents are up. So what we feel around us in Lagos, particularly, I can only speak for Lagos. Prices are up. In other parts of the country, some people say that, look, if whatever we produce in the rural centers, because it's of insecurity, may be difficult transporting them to urban centers. So the price rises there may not be as high. But generally across the countries, almost I can say all commodity prices have risen.
Cross board.
That's what it is.
All right. Thank you so much, Nosike Wajide, research analyst with Financial Derivatives Company, for joining us this morning and sharing your thoughts with us.
Thank you. Always great to have you.
Yeah. So we'll just take a break, and when we come back, the conversation continues. And the just released inflation figures have impact on all aspects of the economy. With a slight moderation, how should we expect investors to behave? Well, we have a senior research analyst with Quadra Securities, Bola Logun Road, to help us understand. And Ladi, I'm sure even these figures will affect your pocket.
Of course.
Will affect how you run your home.
Exactly.
Will affect what you buy and what you do.
Everything.
Every single thing.
And every investment, out there. So.
Yeah, and even in the equities market.
Yeah.
Yesterday ended in the red, and it's been kind of shaky there.
Yes.
The fixed income market has been quiet for some time now. So I really don't know.
Because now it's basically cautious buying now.
Yeah.
Investors are not pouring in the cash.
So we're hoping
like
that this
before.
moderation would mean that there's a little bit more money. I don't know.
Well, and hopefully some kind of continuation with this supposed downtrend. Hopefully.
Yeah, moderation. Let's put it that way. Well, we have Bola Logun Road to join us now and help us understand. Hello, Bola. Good morning, and thank you for joining us.
Good morning. Thank you for having me.
Yeah, so were you expecting the inflation rates to taper?
So like your earlier speaker mentioned, the inflation data was a surprise to analysts in Lagos. Consensus expectation was that we should see the headline inflation trending upwards in line with the trend we've seen over the last 20 months. But contrary to analyst expectations, we saw the headline inflation moderating marginally by 5 basis points to 18.12%. So it was below our estimates by about 63 basis points, while it also came below Bloomberg consensus estimate of by about 68 basis points. So it was a positive surprise from that inflation report released yesterday.
All right, from your perspective, what do you think drove this, you know, since prices don't seem to have reduced at this point?
Yeah, so for us, we think that the most probable explanation for that slight moderation in the headline index can be attributed to what we saw in the food index. So for the food index, we think that given the Ramadan season that we saw in the month of April, so perhaps a large number of consumers decided to front-load the bulk of their purchases in the month of March, given expectations that the month of fasting is characterized by increase in consumer demand, which tends to fuel inflationary pressures on major food items. So we think a number of consumers decided to conclude their purchases in the month of March, and that sort of provided support for prices in the month of April. So for us, we think consumer demand in April was not as significant to what we saw in March, despite the supply constraints we had in the economy. So that was a positive for the food basket. And if you look at the food index, the month-on-month reading declined significantly by about 91 basis points. And that is a divergence from, I think, what we've seen in 2019 and in 2020, where food index tend to increase in the month of April due to the fasting season. But for 2021, I think, given the pressures we've seen on consumers' income, a number of consumers decided to front-load their purchases in order to take advantage of bulk purchases at that time, given that they expect prices to increase in the month of April because of the fasting season.
Well, our former guest did attribute it to the opening of the border, and that it's not as prices are not increasing as much as it was last year. But I mean, this is Quadrus's perspective. Well, the report also shows that Kogi, Bauchi, and Sokoto states recorded the highest inflation, while Abia, Kwara, and Katsina had the lowest in the month. On the review, what are the common trends, between these two groups of states?
Yeah, so for those states with higher level of inflation, I think it is reflective of the persistent security challenges in those major food producing states. And on the contrary, for states with lower level of inflation, it simply means that they are able to benefit from relative peace in their states, which enables free distribution of goods and services in those states, in addition to improvement in activities on major farmland. So that, I think that's the key factor that explains the disparity between states that tend to experience lower level of inflation and states that tend to experience higher level of inflation.
So with this, the recent bombing of police stations and killing of officers in states like Abia, do you think that it will change the status of those states?
Yes, certainly. When you have high level of insecurity in a state, what you're going to find is it will constrain economic activities. Farmers will not be able to go about their daily activities in terms of going to their various farms to plant various crops. And we are in the planting season, but we haven't getting to the peak of the planting season because the rainy season is on the horizon. So when you have high level of insecurity, it will constrain activities on farmlands. And in the medium to long term, the repercussion is that we are likely to see subdued harvest, which will also mean that prices are likely to increase in the months of September, October, where you expect harvest to provide support for consumer prices.
All right, what's your outlook for inflation rate for the rest of the year? Who knows, it might not follow expectations like before.
Yeah, so going by what we've seen in the month of April, perhaps it indicates that we are getting to an inflection point, in which case you would expect that increase in inflation may not be as significant as we initially expected. And more so, in the second half of the year, we also expect the high base effect to kick in, given that last year we had very high level of inflation in the second half of the year. So if you are looking at the second half of 2021, the high base effect would also come into play and which should drive moderation in inflation. But for us, over the rest of the first half of 2021, we still expect that inflation would still trend upwards, but the pace of increase may not be as significant to what we have seen over the last 6 to 7 months. we still expect that we'll hit a peak of around 18.7% in June before we begin to see a moderation in the second half due to high base effects, and in addition to our expectation that the harvest season in 2021 should be more robust to what we saw in 2020, and that will be positive for consumer prices in the second half of the year.
And how do you expect bond investors to react to this, surprising positive news, given that inflation expectation has played a major role in their demand for higher yields?
Yeah, so for bond investors, we don't think there will be any fundamental shift in their demand pattern or trading pattern rather in the bond space. So we still think that aversion for long-dated instruments will persist, given that inflationary expectations still remains largely biased to the upside. In addition, we also expect that elevated fiscal deficit will also mean that government will have to issue more domestic debt instruments in order to bridge the deficit in the 2021 budget. So for bond investors, taking account of those two factors, and we think that they'll still expect yields on the mid to long end of the curve to trend slightly upwards from current levels. So we are still likely to see bearish sentiment persist in the bond space as investors continue to play at the short end of the curve.
All right, still looking at bond investors, how should they realign their positioning on the yield curve in light of this recent inflation report?
Yeah, so for us, we think that we still highlight the need for investors to still play at the short end of the curve. With what we've seen it from the inflation data, for us, we think it's a transitory moderation in food prices. The upside risk to food prices still remains slightly elevated when you consider the persistent security challenges across the different states, across different states of the Federation. We also take into account the liquidity challenges in the FX market, which has prompted some food importers to make recourse to the parallel markets to source for dollars. So for us, we still think that the risk to further increase in inflation still remains elevated in the economy, so which implies that inflation is still likely to trend upwards before the second half of the year. So we still reiterate that investors should still be cautious on mid to long dated instruments and rather play at the short end of the curve.
So the MPC meeting is next week. How do you see this surprise inflation tilting their decision?
Yeah, so for the MPC meeting scheduled to hold next week, I would think that this inflation data would bring some comfort to the members of the committee, given that inflation has diverged materially from the upper band of their medium-term target of 6 to 9%. So we think this would bring some comfort to the committee. However, we think they're also going to be cautious with ensuring that they are not too optimistic that we are now beginning to experience this inflation, given that those upside risks to inflationary pressures still remains prevalent in the economy. So what we think that it's going to be a welcome development to the committee. However, they will still feel that there is need to sort of tighten monetary policy in order to ensure that liquidity pressures in the economy don't amplify domestic inflationary pressures. In addition to that, we think that the GDP report for Q1 to be released next week is also a major macro indicator that would guide and shape the decisions of that MPC meeting next week. As if we also see a positive surprise, we think that would put them in a good position to then tighten monetary policy, given that in past meetings, they have highlighted that their short-term mandates or their short-term objective is to support economic recovery. So if we see strong positive numbers from the Q1 GDP numbers, we think that should then pave the way for the MPC to at least hike the MPR by a minimum of 50 basis points in order to curb inflationary pressures in the economy.
All right, well, we'll see how the meeting goes, but how should investors trade the equities market given the growing uncertainties about the direction of yields in the fixed income market? Are there positive triggers on the horizon that could, bring a halt to this bearish sentiment in the market?
Yeah, so for us, we still think that despite the fact that expectations are that yields will still trend upwards, there are some specific factors to still watch out for that could potentially lead to a downward movement in using the fixed income market. So firstly, we understand that the federal government are considering raising Eurobond in international markets. So the implication of that is if they're able to raise a substantial amount of money that would cover external borrowings and also maybe a part of domestic borrowings, it means that we might see a substantial reduction in the issuances of domestic debt instruments. So that can give rise to a demand-supply imbalance, which is similar to what we saw in 2020. So if that comes into play, we are likely to see yields moderating in the fixed income market due to lower issuances of domestic debt instruments. Aside that, we also understand that government is planning to make use of claimed dividends and dormant account balances to finance the deficit in the 2021 budget. We also understand that they need to secure a court injunction to be able to carry on with that plan. So if that comes into play in the second half of the year, we are likely to see lower issuances of domestic debt instruments, which again would also give rise to the demand-supply imbalance I mentioned earlier. So for us, we think that equity investors can still cherry-pick on high-conviction names across the banking and cement sectors in order to still get attractive dividend yields.
All right, Gbolahan. All right, Gbolahan, thank you so much for sharing a whole lot of information with us this morning. Gbolahan Ologunro is a senior research analyst with Quadra Securities, and he joined us to share his opinion on some of the burning issues in the economy. Well, he was talking about the equities, and Anita is here to follow up on that conversation. Anita, the market was down yesterday, 0.44%. What happened? I know Gbolahan talked about some giants like the cement and all that. I think they are part of those who dragged the market down yesterday, right?
Yes, Sini, thank you. Yesterday, we saw the market make a slight, moderate pullback from the uptrend that it had managed to make last week. But, you know, it was as a result of losses from major big cap companies such as Boa Cement, Lafarge, Boa Cement, MTN Nigeria, GT Bank. So all of that. And don't forget, the market had it was a positive market breadth, but the losses from those major blue chips, at least about 14 of them, led the market to fall by 0.44%, and that also translates to about 91 billion naira loss in value. So, but interestingly, if you take a look at the activity chart, we gained about, the volume was up by more than 63% at about 357.69 million units. And of course, that still tells you that investors are still very much present in the equities market, despite the losses that we had on Monday. And that just tells you that it was just a matter of sell pressure by investors, because the market had managed to make some gains last week. So it's just some people taking advantage of the gains recorded by some of these big cap companies. And of course, that you expect that the market would always react to profit taking. So to tell us more about this, let's join Phil Anegbe. He's a research analyst at Cardinal Stone Securities. So to tell us more, thank you for joining us, Mr. Phil.
Yeah, thank you very much. Good morning.
Okay. So yesterday we saw the bears make a comeback just when you thought that the bulls will maintain their dominance, which they had started since almost about 2 weeks ago. So what can you attribute to this?
Yeah, you hit the nail on the head, basically. You see a lot of profit takers come back to the market to take some profits. I remind you that last week, banking sector was the best performing sector across the market, followed by the insurance sector. So it was understandable to see sell-off in stocks like GTB and Mansard. So that more or less drags down market performance. And in addition to that, we are seeing local sellers in certain names. This has had some foreign interest, but yesterday we saw some local sellers for Zenith, as well as some of the lenders. And we've seen relatively muted reactions to the last NCD options. The yields or stock rates were essentially flat, but that has not been really priced into market behavior since yesterday.
Okay.
Right. So basically we are seeing
Okay, Phil, thank you so much for giving us that update and bringing us up to speed with the market. So, Ini, there you have it. The bull have managed to make their presence known again and on the first trading day of the third week of May. But it's another trading day this week, so we keep our eyes out for how the market is going to, what direction the market will be making today, whether it's going to tilt back again to the bulls or will the bears maintain their dominance.
Yeah, we'll certainly look forward to a better result today, actually. Thank you so much, Anete. Well, we'll take a break now. When we come back, we'll head to London. Welcome back. Well, we now head to London, where Juliana is waiting in our studios to give us updates of what's happening over there. Hello, Juliana. Good morning.
Good morning, Annie.
Yeah. So people out of work dropped from 4.9% to 4.8% over January to March. Economists had mostly expected the unemployment rate to hold at 4.9%, not drop. What's driving this drop?
Yeah, this is a good news story. More confirmation that the labour market in the UK is stabilising. This is the third consecutive month that the unemployment rate has fallen. Now it's at 4.8%, as you said, lower than what some economists had predicted. I think a lot of people are citing the fact that we are now coming out of lockdown, particularly in the hospitality and entertainment sectors. I've discussed this on this programme in the past, that a lot of these companies have lost their staff, not only to Brexit, but just because it was so erratic. 1 minute we're in a lockdown, then we're out of it. A lot of people have been moving away from the hospitality sector. So the 100,000 jobs, well, the 100,000 roles that have been filled over the 1 month have predominantly been in that area. This is a good sign that the economy in Britain is finally ticking over. I bet Prime Minister Boris Johnson is pleased with himself. Chancellor Rishi Sunak has released a statement this morning saying that the job market has always been his #1 priority. But, of course, there is still a little bit of hesitancy. According to the Office for National Statistics, there are still 4.2 million roles that are still being furloughed, so the government are still paying people to stay out of these roles. The furlough does come to an end in September. I believe the Bank of England, at their last Monetary Policy Committee meeting, still do believe there is a potential of unemployment to peak at 5.2% in this country. But if you look at the rates of unemployment around the world, Britain is still faring much better than their European and American counterparts.
I'm sure you're happy about that. Well, the trade deal talks on opening up new markets with Australia. Are you privy to the details and any idea when it will be sealed?
Well, it's a big conversation, and apparently this potential free trade deal with Australia has caused a huge internal row within departments in Whitehall. On the one side, you've got the International Trade Secretary, Liz Truss, who has been dotting around the country trying to sign as many post-Brexit trade deals as she can. And on the other side, you've got the Department for Agriculture and the Department for Environment, which is run by George Eustace. The issue with Australia is that a lot of the produce that comes from farmers can be raised here in the UK, particularly when it comes to Scottish and Welsh farmers who produce a lot of lamb. If this free trade deal was signed with Australia, that is going to spark a huge domestic issue with these farmers at a time where we know that independence, particularly in Scotland, but also there are mutterings coming out of Wales. They want their independence. If Boris Johnson signs a free trade deal with Australia that gives priority to Australian farmers, that's going to be an issue. But on the other hand, this is going to be the first post-Brexit free trade deal that isn't a rollover of the status quo that was within the EU. So it's very, very important that it's signed. Scott Morrison, the Australian Prime Minister, will be in Cornwall next month at the G7 meeting. He's not part of the G7. He has been invited. They were promised the deal would be signed until then. So we'll have to wait and see how Boris Johnson gets his way out of this one.
Yeah, we'll certainly wait and see, Juliana. Thank you so much. Well, I know you have a whole lot of more information for us, but we'll have you during Business Incorporated to share more of that. So enjoy the rest of your day. Well, we'll move over now to the crypto segment. Still a sea of red, or are there patches of green?
Well, the big boys are still in the red. Bitcoin, Ethereum, but we have some patches of green here. We see Polkadot is in the green. Link, Matic, Uniswap, Solana, We have KSM still in the green, XRP in the green, Doge in the red at this moment, looking at Coin360 there. And market cap, $2.11 trillion, up by 1.92%. 24-hour volume traded in the total crypto market is down about 17%. And Bitcoin dominance hits the 30 region today, 39.93. Price of Bitcoin at 8 a.m., $45,000. Up about 1.30%, 24-hour volume, $64.82 billion traded in Bitcoin. Let's talk to Solomon Amunde now, digital market analyst. Hello, Solomon.
Yeah, good morning, Larry. Good morning.
Good morning, Solomon. Well, you know, Bitcoin has dumped about 18% in a couple of days now, and it looks like the altcoins are holding up well. Any reason for this?
Yeah, actually, Bitcoin has had a fantastic run at the expense of the altcoins, and it was only a matter of time for Bitcoin to massively correct, which we have seen that up to 32% correction. So what's happening now is the money has been flowing. First, it flowed to Ethereum, and we saw Ethereum hit $4,300, and now it's flowing to altcoins. So we're expecting the altcoins to do at least 50% rally within this week and next week.
Okay, interesting. Well, so what altcoins are you watching at this moment?
Yeah, from yesterday, I started looking at sushi DeFi projects per se, DeFi projects. So SNX has been doing very well, so for 48 hours now. Matic has been doing very well for over 72 hours, and I'm expecting sushi too to do very well, majorly all the DeFi projects. And the Solana token too has been performing very, very well.
Okay, but looking at Bitcoin's price now, do you expect it to go lower?
No, personally, and looking at the charts, I think the lowest we can see is $40,000. That's the lowest we can see. Most persons are tying the correction to what happened with Elon Musk and Tesla, but I don't think that's it. I feel that just forced the correction to come a bit earlier, but the correction is totally normal.
Okay, and I noticed that on Twitter, a lot of traders are not so happy with Elon Musk. That's, you know, crypto traders. Do you think, you know, he would lose that influence on the market anytime soon?
I feel he wouldn't. He had to tweet yesterday to assure everyone that Tesla has not yet sold their Bitcoins and they are still holding, because as we could see, it also affected the Tesla stock. It's dumped by over 5%, and it's still low here. As of this morning, it's still low, about $500 and something.
All right. All right, we'll keep tracking that. Anyway, Solomon, thank you so much for the update.
Okay, thank you.
All right, top alt by market cap, BNB is down 0.40%. Cardano down about 2.72% after making that incredible run to about $2.11. Doge down 49 cents. But we have XRP. XRP is doing well this morning, up about 6.75% at $1.52. And top five gainers, Matic, as Solomon said there, Matic is having an incredible run there at $2.14. Matic was stuck at 200 sats region for the longest time, but it's doing well this year, up about 32%. SNX also doing well, up 20%. Aave, $660, up 19%. And Sushi Swap is doing well this morning, up about 16%. You should actually look at other swap exchanges, because, you know, Sushi is up at this moment. Other exchanges might actually follow. Top five losers, Aleo down 17%. ICP, Internet Computer. This one came out about $700. Massive outing there, and actually was with the big boys at the top five on the market cap, but it's down now to about $199. I don't want to be one of those that bought at the top there. It's down 8% this morning. Hot is down 5%. Dash down. Digibyte is also down. Digibyte is still my coin to watch at this point. Let's look at the charts here. Look at Bitcoin. Bitcoin chart on FTX exchange. We see the MACD cross on the one-day chart is still in bearish territory. We see where it cut here, had a bullish cut up here, but still suspended that run due to Elon Musk's tweet, and came down to this 200-day moving average. So it is holding on this 200-day moving average. It broke the 100-day moving average on the one-day chart. So the prices to watch are the $38,000 region. You have to watch that closely. And for the short term and for the long term, the $87,000 range is the one to watch.
Yeah, well, can you imagine? I remember when we were celebrating Bitcoin at 50,000, and now it's gone lower than 40,000.
Exactly. I know 50K was your sweet spot.
Well, maybe it's time for me to buy the dip, you know.
All
right. Well, that'll be all on the show this morning. Thank you so much for watching. I'm Ini John Mekwa.
And I'm Ladi Williams. Thank you for watching.